the major probable risk to the U.S. economy comes from the elections. And the economic policies of a new Trump administration will be very different than those of a Harris administration. If you take at face value what Trump says, he says, I'm going to impose tariffs on all imports in the U.S. of 10 to up to 20%, up to 60% on those from China. He wants to devalue the dollar because he thinks it's too strong and has led to deindustrialization. He wants a more dovish Fed. He'll have a chance to change some of the leadership of the Fed. And the Center for Responsible Budget just the other day said that his fiscal policy will increase the deficits and the debt by $7.5 trillion over the next decade. That's well above what even Harris will have it, but it's, unquote, only 3.5. Right. And it will have a restriction to migrations, severe draconian restriction to migration. I don't know if it's going to deport millions of people, but even not letting them in implies a significant reduction in the labor supply. So all these things together, all these policies, trade, currency, migration, monetary and fiscal policy, in my view, imply higher inflation, lower economic growth, higher bond yields, and potential for a correction in equities.
You're not willing to give up on stagflation. A lot of people are saying maybe it's over.
I don't think it's over for the following reason. The three negative aggregate supply shocks of COVID, of course, have gone away. But as I pointed out, the economic policies of a Trump administration, in my view, are stagflationary because whether it's immigration, whether it's the currency, whether it's trade, whether it's monetary and fiscal policy, they are increasing inflation and they would reduce economic growth. So that, call it stagflation light or stagflation, but they would be stagflationary. And as I pointed out in my mega threat book, there are other forces that are more medium term that are all stagflationary. Decoupling and protectionism, restriction to migration, aging of population, reshoring and friendshoring, geopolitical risks that lead to fragmentation, climate change, new pandemics, backlash against liberal democracy leading to fiscal policies that are pro-labor and union, increase wage growth, and potentially even de-dollarization, gradual, but they will increase essentially
Can you
prices.
model, well, this is your wheelhouse. When you were with President Clinton, can you model a weak dollar?
Can I model it in which
Do
sense?
you predict a weak dollar?
It depends. You know, if we have very large fiscal deficits, and if we have very large current account deficit, these twin deficits are going to continue. In spite of the strengths of the private sector, I think at some point the bond market vigilante is going to wake up. And in the last few years, in spite of these twin deficits, the dollar was strengthening because we had tight monetary policy. And therefore, the capital account was essentially compensating for a very large current account deficit. But if that large current account deficit remains, at the same time, interest rate differential are implying that the capital inflow in the US are going to be less, let alone the fact that we are weaponizing the dollar and some country may be gradually de-dollarizing, that would imply over time a weaker dollar.